The agenda for today is to cover a bit of historical background, not more than necessary, but I think a bit will actually help you on how the currency market evolved as an over-the-counter market, and also how MetaQuotes with its MT4 platform created the retail trading market as we know it. Then I'll discuss a few business models that you're likely to encounter as an independent trader. By the way, you'll notice that I refer to independent traders throughout because I hate the term retail traders. It has a derogatory connotation to it, implying that somehow the people who trade from home are more stupid than the people who trade for banks, and I just think that's a completely bollocks statement. So I will refer to independent traders throughout. And very importantly, from your standpoint, what are the incentives of different brokers operating the different business models? And at the end, if there are any questions throughout, please ask them. If I think that they're not going to be covered elsewhere, I'll try to cover them as we go along. If not, I'll just defer towards the end, where I have planned for plenty of time for you to have any questions related to this, or indeed any other areas where you think I could help you. Okay, so without further ado, let's get going on the background that I mentioned. The background to it really is just, I want you to appreciate we're now all trading from our homes and possibly connected via the internet, even though we're possibly in different parts of the world. And it seems a logical thing to be doing, but 15 to 20 years ago, this was completely impossible. As impossible, by the way, as it was for someone, an independent person like us, to trade with our independent wallets in the world's currency markets. 15 years ago, if you wanted to go to the interbanking market with 1,000 euros in equity, then the major banks would have basically looked at you and thinking that you were a bit of a loony. So that was completely impossible back then. Luckily enough, today, this is possible thanks to the evolution of Brokernomics and the emergence of brokers whose business model is to provide with independent traders like yourselves with access to the big boys market, as we'll see in a second. With that, there have been a number of different business models that have emerged and that I'll be discussing at some length today. Importantly, sorry, there's something with my computer. Now it should be back. Importantly, I would like to set some of the terminology right, because a lot of what many people in the forums know as brokers are actually everything but brokers. They are dealers. And in many cases, they're also broker-dealers, but they are not pure brokers, although there are some pure brokers. If you're getting a bit confused with all this terminology, don't worry, but it's actually important that I make that distinction, because hopefully going forward, you will not fall for what people tell you, especially when they're lying. So we're now going to review inline the business model of an FX dealer. Then we'll go for the business model of an FX broker-dealer, and we will finish with the business model of an FX broker. And as you'll see, whilst they are all offering you the possibility of trading foreign exchange, they all have very different incentives, and you should understand those incentives before you choose a broker. So when we talk about a dealer, let me briefly describe what a dealer does. So at one of the value chain, there's you who wants to place a trade, and you have gone to a dealing desk, so it's so-called broker, even though strictly speaking they are dealers, who sources a market price feed. What's happening there is that whenever you're going long the euro dollar at the bid, the dealing desk is going short the euro dollar at the ask, and it's basically a trader just like you. So if you're going long the euro dollar and it goes your way, you're winning. If it goes against you, you're losing. And from their standpoint, it's exactly the same thing, but opposite, precisely because the trade that you have placed never reaches a so-called market, And it really stays as an over-the-counter agreement between you and the dealing desk, whereby you say, well, if the euro dollar goes up, I win, and if it goes down, I lose, and you win. That's basically all there is to it. Now, this model has received a lot of bad press, and it's not entirely right that it receives that bad press. So just to clear the air ahead of time, because as I mentioned before, when in 2002 or 2003, if you wanted to trade foreign exchange in the thousands of euros, there was just absolutely no way you could do it if there wasn't someone making the market or being a dealer in front of you. So don't, there's bad things about it, but don't blame it all on them, because they actually, without them, we probably, neither FX Street, nor I, nor you would be in this webinar. So what is the business model for a dealer? Well, on the one hand side, we have the revenues, and the revenues are made up of the trading profit and loss, because at any given time, the dealer is buying something from some customers, and it is selling it for more to other customers, and in the process, he is pocketing the bid-ask spread. In addition to the bid-ask spread, the dealer is making a margin on the swap and the funding that you pay when you take leverage overnight, because the dealer is charging you for that funding, even though very likely, actually, if he is a pure dealer, for sure, he is not borrowing that money, therefore he's not having any funding charges. On the cost side of things, there are two costs to a dealer. The most important cost is the cost of the capital of its shareholders. Obviously, the shareholders of a dealer do not invest in a dealer to not make any money. So they need to make a return on their investment. And the problem with that return is that it's the opposite of the P&L of the customer block as a whole. Importantly, what's happening here is that any customer's net win, whenever you are up the spread, somebody else has to be losing. And that somebody has to be either other customers with that broker, and if all the customers with that broker are winning at the same time, the person losing at the other end is the shareholder of the broker or the broker itself. Okay, this is a very important thing to be doing. Similarly, the reverse also applies. If all the customers with a broker at the same time are losing, then that is money that is flowing straight into the broker's pocket. As you understand in a second, this has implications for the incentives of the broker. What the broker likes is granular customer profit and loss. What does this mean? Well, granular means ideally a dealer, sorry, I keep saying broker and it's actually a dealer. A dealer loves to have a lot of customers who all have just about the same size, who trade obviously as frequently as possible, because the more often the money rotates, the more money is flowing into the dealer's pocket. And the trick for a dealer is that those customers are hopefully all taking the opposite of each other's trades. Why is that? Well, because if I go along the euro dollar and you say, me as a customer of the dealer, I go along the euro dollar and you at the same time go short the euro dollar, then the dealer that's allowing us both to do so is pocketing the spread on both sides without taking on any risk, because ultimately we are balanced as a net, which is what matters to him. Down the line, smart dealers know that they need customers to trade for the long term, because if customers lose quickly, they don't develop a habit for trading, and the investment that the dealer has made into marketing will be gone with the customer's losses. So I don't think it is strictly true to say that dealers want customers to lose. But then, of course, there are dealers, and there are a lot of bucket shops out there. So I guess I'm probably being too nice to them. The other part to what a dealer likes is that they prefer to have traders who take trades for the longer term, and by longer term I mean minutes or hours, than they do people who trade for much shorter intervals, because the risk in that trading behavior is a lot harder to manage when the trades are very short than when they are longer. Why do the dealers like granularity? Well, very importantly, you can think of a dealer as, say, a casino, because ultimately that's what it is. And if what they don't like is for any individual customer to be so big that any individual bet by that customer could take the dealer down. And in those situations, if, as I mentioned, all the customers are evenly matched, then there is very little shareholder capital that is required to provide the liquidity to all the customers, precisely because it's actually the customers who are providing the capital, not the dealer. This was probably by far one of the most important slides in this webinar. So if anyone out there wants to pose a question here, I'm very happy to take them now, because I appreciate that the subject is complex and I'm not a very good explainer at times. Okay, about to go. 1, 2, 3. So either I'm doing an amazing job or you guys are all asleep, but hopefully it's the first part. To sum it up, what is the ideal analogy for a dealer business model? Well, to begin with, think of a dealer as a fishbowl, because we're really talking not about the foreign exchange market, but actually we're really talking about the bilateral transactions taking place between a dealer and his customers, because the money is not going anywhere else. And as I mentioned, what a dealer loves the most is when all these little fishes are turning round and round and round, but hopefully without it making too much splash by people making too much money or losing too much money. And the ideal situation then, of course, is that the customers make each other's market. There's very little capital required by the dealer, and he gets to keep the spread and the swap, which is pretty much a money printing machine. The things that dealers, of course, dislike is situations when any individual of their customers stands head and shoulders above the rest, because if they are too big, then they could take a very big leveraged bet. And if that bet went for the customer, then the dealer would be losing at the losing end, which is, of course, what he doesn't like. Indirectly, this also means that dealers don't necessarily like winning customers, because, of course, winning customers tend to grow and grow and grow, and eventually they could become the king of the pond and become dangerous for them. Shorter term, of course, if they look at it myopically, they even dislike good traders even more, because, of course, a good trader is someone who's taking away money from the overall pot, and that money, if it will not be going to the dealer himself, so they dislike that. Although, as I mentioned, there are the brighter and the more stupid type of dealers. It would be quite stupid for dealers to think like that, because if the word spreads round that they dislike good customers, they will not have a very good business in the long term. Very importantly, now we get to what matters to you from the standpoint of the trader. So what is the biggest issue with a dealer? Well, the biggest issue with trading with a dealer is the fact that you're de facto playing a football match where the other side de facto is the referee and the player at the same time, because they set the price that at which trades get cleared. So, for instance, it is quite simple if you have an MT4 manager terminal to introduce slippage into the order execution for customers, whereby if the trade goes for the dealer, then it is accepted. If it goes against the dealer, then it's either slipped or requoted in a way such that it's a win. It can literally be made to be a game which is heads I win and tails you lose. The other issue, of course, is stop hands. So if you are placing a take profit or a stop loss order into a dealer's MetaTrader 4 server, then the manager of the dealing desk will know exactly where your stop is, and they can basically manipulate the so-called market price to hit your stop loss, so that your loss is locked in and their profit is locked in without them having to be accountable for in any way. And that's a very long way of saying that the interests of the owner of the broker and the interests of his customers are not necessarily aligned in ways that are healthy. The second and perhaps overlooked issue is counterparty risk. So counterparty risk arises from the fact that it could be that another customer with your dealer is making a ton of money, so much so that he wins the ultimate game and the broker goes bust. And you have your money deposited with the broker thinking that it's all safe, and suddenly you do have a problem, because if the broker's capital is gone, then money is owed to the winning trader, which is not going to come from the broker's pocket and will ultimately come from your pocket. So be very, very, very careful with whom you trade if he is a dealer, because they are taking big risks and they may not be good for them. So with that, we have covered the pure dealer model, and we're now going to see a variation around that model, which is the broker-dealer model, which has some parts to it that's a dealer and some parts where he is a broker. So what happens when you place a trade long with the euro-dollar with a broker-dealer? Well, you go long the euro-dollar, and then the broker, or the broker-dealer rather, has a choice. He has a choice to B-book your trade. In other words, bet against your long bet by going short the euro-dollar, or he can choose to A-book the trade and go long the euro-dollar by the same amount that you've gone the euro-dollar with the broader market in a way such that he's not taking any risk whatsoever, which basically means the problem that we've just been discussing goes away partially. This process of deciding what to do with any individual trade can be managed at the individual trader level. For instance, you could have a rule whereby you say, whenever there's a good trader who I know is going to make money, then I basically don't want to do the opposite of what he does, because that would mean taking a loss. And instead, I'm going to pass that trade directly to the market so that I just make the spread and don't take any risk. On the contrary, of course, if they know that the trader is bad, what they will then say is, well, over the long term, this guy, whatever he's doing is going to be a bad bet. By taking the opposite of that bet, his money is going to flow into my pocket. So that's basically what I do. It's like, for good traders, I pass them onto the market. For bad traders, I take risk. And for average traders, I have some capital on the dealer side, which basically means that I'm still pocketing the spread, so I'm happy. As we'll see later, that's a stupid thing to be doing, and it's actually bad for you. But unfortunately, most MT4 brokers who operate B-book are pretty bad risk managers, and the only way they know how to do these things is by managing at the trader level. So it's a bad thing for you. There are bigger players out there who have smart stuff, who manage the risk on the portfolio level, which basically means by default, they take the opposite of whatever trades the customers are taking. And whenever their own risk exceeds a level which makes it dangerous for them, then they take a hedging trade with the market to protect themselves. Along those lines, the broker-dealer's business model has, on the revenue side, a trading P&L, just like with any standard dealer. At any given time, they're buying something from some customers for less than they are selling that in all or in part to others. And again, the same swap situation applies as with the dealers. On the cost side, they also have capital, less capital than a dealer, but they also need capital because they still need financial muscle to take the opposite of customers' bets if they are B-booking them. And still the P&L situation, whereby we're talking about a poker table where customers lose and the owner of the broker wins, still applies, although to a smaller degree, with the proviso that they have the opportunity of not competing with the best customers, as I just said, by simply passing them on to the rest of the market. The broker-dealer has an additional cost which a dealer does not have, and that is that whenever the broker-dealer is hedging risk with the market, it is going to pay execution costs to liquidity providers or his prime broker. And presumably, if he is operating on an MT4 platform, he will have to pay to a bridge provider to send the trade from MT4 to the broader market. because MT4 is not capable of doing that out of the box. In summary, what is a broker-dealer? Well, it's essentially at large the same as a pure dealer. Customers make each other's market, and the dealer keeps the spread on the swap. The broker-dealers also dislike risk, and but they have a way to get out of it, so that basically whenever a big customer makes too much money, instead of systematically trading against them, what they do is they pass him onto the market. So that problem is solved for them. But sometimes, of course, all customers will tend to go one way or the other. In that situation, they have to hedge, which costs them money. So the big difference between a broker-dealer and a pure dealer, as we said, is the possibility of taking the fish that are not pleasing to them out of the B book, the closed fishbowl, and putting them into a separate fishbowl, which is in this case would be the market. As we mentioned, the smart brokers hedge at the portfolio level, and this has implications because a market maker who hedges at the portfolio level is not bad for traders, whereas market makers who do hedge at the individual trader level are bad for traders, as I'll explain in a second. The worst problems that we discuss for the dealer are mitigated because the issue with the requotes, slippage, and last look should not necessarily be there if the broker-dealer is good, and the counterparty risk is largely gone because presumably the broker-dealer will be smart in passing the risk onto the market so that they're not taking the risks that they cannot afford to take. The bad issue about a broker-dealer that hedges on the individual level is for particularly good traders. And let me explain why. Let's say you start small, you're a very smart trader who starts out with a broker-dealer, and you develop an execution algorithm that is very good in making money. Very likely, what you will see is that your execution algorithm goes very well, very well, very well, keeps growing, until one day, all of a sudden, it stops working. And then you go, what the fuck? Market conditions haven't really changed. Why is an execution algorithm which was systematically making money not making money anymore? Well, welcome to the A book, B book transition. What happens there is that the dealer starts noticing that you're systematically making money from his pocket, and that you're also becoming a bigger and bigger risk with a bigger size, and magically they switch your price feed to the A book, which in other words means you start trading at different prices than you were trading so far, because you're now trading against the real market, not in the dealer's fishbowl, and the real market prices are different from what your execution algorithm has been optimized for, and all of a sudden you find yourself without your money printing machine, which is obviously, it's not bad in the sense that you have been able to make money for quite some time out of the dealer's pocket. So that's the good part to it. The bad part to it is that by the point that you have grown your account, you're probably thinking of doing something more serious with your algorithms. You're probably thinking of raising investor capital. And at that point is when you realize that you do not have a scalable money printing machine, and you have possibly spent a lot of time polishing an algorithm, which is really no good. Which brings us to the last of the possible alternatives, which is direct market access brokerage. And this is a pure broker model, whereby you send your trades to the broker, and the broker goes to a market. For instance, in the case of Darwinix, the LMAX exchange gets the liquidity for you in exchange for a commission. A pure broker never takes any risk against customers, because all they are really is an intermediary that helps the customers trade without getting in the way. Technically, the way that is done is that whenever you go long the euro-dollar, the direct market access broker, for instance, Darwinix, will go short the euro-dollar with you, acting as your counterparty, just as like a dealer would do. But in addition, we go long for exactly the same amount at exactly the same time with the market, in this case the LMAX exchange, so that the market is short the euro-dollar, but Darwinix does not have any risk, or a pure broker does not have any risk. And in that situation, your trade really has reached a proper market. So you're now trading against the big guys. As we'll see, that has good and bad things to it. A broker's business model is actually a lot simpler than the model of a broker-dealer or a dealer. The only way that a pure broker makes money is on commission. So when you trade, you're paying the market spread, and the broker is not fed from that. All the broker makes is a transparent commission that you are paying at retail prices, because presumably you trade small amounts. You also pay the same swaps that you pay anywhere else. And then the cost base for a broker is a commission just like yours, but obviously smaller, because the volume for a broker is much bigger than that of any of its individual customers. And that's where the money comes from. It's the arbitrage between the retail commissions that are being charged and the wholesale commissions that are being paid. Opa. My computer's playing crazy, sorry. So in a nutshell, what is the broker business model? Well, right. So very good question, Manoy. Is there a charting platform that the big guys use? Well, the big guys tend to not trade on MT4. There are two alternatives there are more professional packages for which you'll have to normally pay. A typical good charting interface will cost something like $80 to $100 per month. And one that people seem to like a lot would be multi-charts. Let me write it here. You can look it up on the internet. And then there's also TradingView, which is a startup owned by Multicharts that provides very good charts for free on the internet. So you may want to check those too. MT4, if you ask me, after having spoken to a lot of good traders, MT4 is not a very good charting platform. And then the slightly different price levels at any point in time, that's exactly the point that I'm making. So when you are trading Forex, you're trading in an over-the-counter market, which means the price is found by asking a bunch of different people at the same time. Each of them is listing slightly different prices, and then you kind of go for the one that gives you the best price for whatever it is on the bid, on the ask side. And that is, so to say, the market price. But there's no such thing as a market price. It's really a function of how many people you ask. Unless you go to the LMAX exchange, which is what DarwinX does, in which case the market price really is the market price, because it comes together by matching the order book, just like it would be done on a futures or a stock exchange. Did that answer the question? All right. Okay. So you can think of a broker basically as a messenger whose mission is to go to the market, get you the liquidity as fast as possible, and come back to you for as low as possible a fee. The important thing to understand with a broker is that if you're getting slipped, it's because the broker is getting slipped. In other words, actually, when you trade with DarwinX, really all you are doing is trading the DarwinX omnibus account at the LMAX exchange. So if for whatever reason something does not go well with your trade, it is because something did not go well for DarwinX, and that basically means that I will make darn sure that things are working the next time, which would not necessarily be the case if you were talking to a dealer or a broker dealer. The major pitfall if you're used to making easy money by scalping against stupid dealers, sorry, excuse my English, is that when you go to a proper exchange, then you really are trading against the broader market, and then the easy money actually disappears. So the bad news is that you will have to work harder for your profits. The good news is that if you manage to make profits in those conditions, then you genuinely are a money printing machine, and you will be in a position to attract investor money that will scale your returns way beyond what you would be able to make just by trading against a dealer. So basically, you're no longer in the fishbowl, you're actually in the broader ocean, which offers endless possibilities, but also there are plenty of piranhas in there, and it could be you that gets eaten and not the other way around. But that's the price of growing up. So at Darwinex, that's the model we actually prefer. So to summarize the points that I have made so far, ultimately, there's no such thing as a good or a bad broker or dealer model. It really depends on what you're looking for. So, but there are some points that really don't admit any negotiation. The first point is regulation. I see over and over and over again people who choose to trade with brokers regulated in, well, dodgy places like the Virgin Islands, or, you know, they're not even regulated, they're just basically registered, which basically means that they have not gone through a proper vetting process, like the vetting process you have to do when you apply for a broker license in the UK. If you go to the Financial Conduct Authority, then trained personnel will check the CV of the people managing the broker to spot both that they have the capabilities to do the right thing, and also that they have the integrity to not screw their customers. And it just defies my understanding how people would choose to deposit hard-earned savings with brokers who have not passed that test, especially when there are plenty of brokers that are regulated by the FCA. Darwinex is, of course, one of them, but there are others. So do yourself a favor and do not trade with unregulated brokers, and least of all, unregulated dealers, because then you're really asking for a lot of trouble, and it's only your fault if things go wrong, not the dealers. Okay, so that really is a condition sine qua non. If you are trading with unregulated dealers, really ask yourself what the heck you're getting out of it, because it's really not a rational thing to be doing. Beyond that, the thing becomes more nuanced. So if you are a scalper or you like to trade the news, then really, if you want to make money, the best thing you can do is find badly managed dealers, because they would be the ones that move the price slower, and you would be in a position to make free money by arbitraging between them and other brokers. So my advice, if that's what you want to do, go find the most stupid dealer you can lay your hands on and make money from them for as long as it lasts. But whatever money you're making, keep it safe, because of course, if you're winning consistently against the dealer, chances are some other people are winning against the dealer as well, which could very well mean that they go bust and your money goes with them. Okay, and then the last bit, if you really are trying to make the jump from making a lot of percentage return on small savings and going for managing millions of investor capital, then I would really recommend that you go as fast as you can to a proper broker who has a connection to the FX interbank market, and that is routing 100% of your trades, because it will be tougher than at the dealers. But once you have come up with a winning strategy, then you are sure that it's not just a mirage, it's actually a genuinely money printing machine. So that really is my few cents of advice in this situation. Basically, with this, we've covered the agenda for today's webinar. I don't know if I'm sure there are plenty of questions. I just don't know if it was so bad that you're not even asking them because you didn't understand anything, or maybe I've done a good job and explained everything. But so if you want to ask any questions, now is the time. And if for whatever reason something occurs to you which does not occur to you in the next minute or so, just email me at juan@darwinex.com, and I will be very happy to reply to it. Um, okay, so if you have been trading in the sea all the time, then there's no problem in upscaling. So that's no problem. The point you have to understand is that, and you mentioned before, when you ask different providers, they are all listing slightly different prices, and basically that offers an opportunity for arbitrage, because if the bid with one broker crosses with the ask of another broker, you can make free money by going long with one of them and going short with the other one. So a lot of scalping strategies de facto are really doing that, and they are not scalable. So what happens there is that the profits exist in the sense that you can make them with an account of, say, 20K, but the moment you start trading an account with 500K, whenever you send your 500K to the market, then the market is going to move. There's going to be some market impact, and ultimately the investors will not be making money. To give you an example, let's say you have a strategy that makes 6 pips on average, and you're making those 6 pips no problem with an account of 10K. And then as you keep growing and growing your account and you start managing 1 million of investor money, then what happens when you go into the trade with your 1 million plus the leverage that you're deploying will be that the market price moves, say, by 1 pip against you on the way in. And then, of course, when you want out, it moves by another pip on the way out, which basically means before you were making 6 pips, but now you're losing 1 pip on the way in, 1 pip on the way out, you're only making 4, and that is making your strategy stop working until eventually you're not making any money on average anymore. It really is all about scalability. I don't know if that made it clearer, but I'm very happy to take this offline and have a Skype conversation. Correct. So on that one, you do pay a spread, but you're paying the market spread. That's basically the spread that, we're paying the same spread as you. So, you're paying the market spread. The only thing we charge you for is the commission. If you want, we can have an offline conversation on this one. But I guess the webinar is one-to-one between you and me. So we probably close it off and take the conversation offline, if that's okay with you. Okay, so let me add my Skype. My Skype is Juan Colón Bolilla. If you add me, I'll be very pleased to take this offline. Okay, well, thank you very much for FX Street for providing this opportunity to reach traders and hopefully help them improve their knowledge. And we look forward to collaborating next time.